We just got a new inflation report and you can tell the Fed is getting worried. The new inflation report says that inflation has gone up month over month, although economists expected that. But the reason why the Fed is starting to get worried is not necessarily because of inflation or the economy per se, it's because of Donald Trump. Donald Trump has promised big interest rate cuts in 2025. But Jerome Powell, who is the chairman of the Federal Reserve Bank, is saying that he is not going to be as aggressive with these interest rate cuts if the economy and if inflation don't warrant it. Meaning Jerome Powell is kind of hinting that unless we see a recession, he's not going to be as aggressive with interest rate cuts. So we're starting to see a butting of heads between President-elect Donald Trump and Jerome Powell, who is the current chairperson of the Federal Reserve Bank. And then Jerome Powell was asked, if Donald Trump asked you to leave, would you resign? Jerome Powell said no, because technically, Jerome Powell cannot be fired by the president that easily. But let's dig a little bit deeper into all of this. Let me start by talking about what the inflation report said yesterday so you understand where we are in the economy and inflation. The CPI report, which is a Consumer Price Index report, said that between October 2023 and October 2024, inflation came in at 2.6%. which is a little bit higher than where we were September to September, which was at 2.4%. But the real inflation culprit here is none other than housing, because the housing costs contributed to over half of the increase in inflation. The top 5 places where we saw the most inflation over the last 12 months are: number 1, car insurance prices; number 2, housing costs; number 3, airfare costs; number 4, meals; and number 5, education. And the top 5 lowest inflation, where we actually saw prices drop over the last 12 months, are: number 1, gas prices; number 2, rental car prices; number 3, used vehicle prices; number 4, electronic prices; and number 5, toys. This is why they say personal finance is personal, and why the reported inflation numbers aren't always the real inflation numbers for so many people, because some people use more of certain products than others. For example, if most of your housing costs go into eating out and your housing and your car insurance, then the inflation numbers are going to hurt you more than the people that are spending a lot of money on, say, driving and gas, rental cars, and buying used cars. So that's why inflation is so personal. But I want to switch now and talk about what is going on between the president and the Federal Reserve Bank, now that you understand kind of where inflation is and what the Federal Reserve Bank said they want to do with inflation. Now, I've been talking about this for the last week now, but a lot of people have been seeing the markets booming, they've been seeing cryptocurrencies booming, and everybody's wondering what you should be buying now. And I want to start by giving the same disclaimer as before. Number 1, I'm just a random guy on YouTube. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Number 2, if you're a long-term investor, you're investing in the S&P 500, the stock market, whatever it might be, you're investing into index funds, ETFs, mutual funds, it doesn't matter what's happening in election cycles, you're investing for the long term. So whatever's happening in the White House does not affect you. And we have seen over the last century, I published a report on this recently, that stocks have gone up under Republican and Democrat presidents. Stocks have also gone down under Republican and Democrat presidents. But regardless, over the last century, we've still seen the stock market go up. Now, the person who's in the White House can control how our GDP kind of fluctuates, because the biggest spender in our GDP, in our economy, is none other than the government. And so obviously the person who's in the White House has some control over government spending. And that can create new opportunities to invest in certain industries and companies depending on where the government is spending their money. But again, this gets a little bit more sophisticated for investors that want to be more involved with their investments. If you're just a long-term investor, none of these things matter. But for those of you that are a little bit more involved with their investments, this is where studying those opportunities can be very valuable. And on November 19th at 10:30 a.m. Eastern Standard Time, I'm hosting a live, free, and virtual workshop where I'm going to be going over the Trump policies and plans and how they can create unique investment opportunities, what industries, what sectors, and things you can be aware of. So I'm going to be breaking that all down on November 19th at 10:30 a.m. Eastern Standard Time. If you'd like to join me, it's free. And I got the link for you to join down in the description below. Now, although the Federal Reserve Bank is called the Federal Reserve Bank, they're not a bank. You and I can't go there to deposit money. They're not a reserve because they don't sit on any cash reserves, and they're technically not federal. It even says so on their website. So it's a little bit of a deceptive name. But this is where we're starting to see a little bit of controversy as to what the president can do. Now, starting with what the Federal Reserve Bank's duties are. The Federal Reserve Bank is there to monitor the monetary supply and monetary policy of the United States and the dollar. That means they have the ability to control interest rates, and they have the ability to print money. So if the government wants to spend money they don't have because the government is not generating enough tax dollars, the government needs to then borrow this money from somewhere. And if they can't get enough money by borrowing money from its citizens or foreign countries, then they will turn to the Federal Reserve Bank, who can then create this money out of thin air and then loan it to the United States government. Alternatively, the Federal Reserve Bank also monitors the economy, and then they control interest rates. After the 2020 pandemic, the Federal Reserve Bank cut interest rates all the way down to zero as a way to stimulate the economy, to stimulate spending, to get people buying houses, to keep people buying cars, and to borrow money and spend money to boost the economy. That then went on until 2022. Between 2022 and the first half of 2024, the Federal Reserve Bank raised interest rates and kept interest rates the same as a way then to fight the overheating economy. We saw very high inflation, and so the Federal Reserve Bank then worked to raise interest rates as a way to cool the inflation levels down. Now, the Federal Reserve Bank's goal was never to resolve the inflation. Their goal was never to see deflation. Their goal was to see disinflation. Disinflation is when you see the prices of things continue rising, just not as fast as they were before. During the peak of inflation over the last few years, we saw inflation rates hit past 9%. That meant that the prices of things on average, according to the reported numbers, were growing by over 9% a year. So when the Federal Reserve Bank wants to see now 2% inflation, this is their new inflation target. They want to see 2% inflation. That means they want the prices of things to keep growing, just not as fast as they were before. Remember, in 2021, 2022, we saw a record 9% inflation. And so now they're trying to bring that number down to 2%. CPI is currently at 2.6% according to the most recent numbers. So we're not at the 2% level yet, but this is where the Federal Reserve Bank has felt confident enough in the economy, in inflation, to start cutting interest rates as a way to start stimulating spending again, while hopefully not making the inflation problem worse. This is where now we start to see some interesting things happen. Because now we have Donald Trump, who is the president-elect who's going to be entering the White House in January, who has made some very bold claims and promises when it comes to interest rates. Trump says that he wants to see a big drop in interest rates by the Federal Reserve Bank. But the person who decides what happens with interest rates is the Federal Reserve Bank and Jerome Powell. Now remember what I said just a minute ago. The Federal Reserve Bank is technically not federal, which means they're supposed to be an independent body. They're supposed to not be influenced by the president. Now notice how I'm saying supposed to, because we've seen unique things happen, especially post-pandemic. So when Jerome Powell was asked if you would step down, if Donald Trump asked you to step down, Jerome Powell said no. And then he went on to talk about if he would change his policy decisions based off of what Trump wants. Let me read you directly from what Jerome Powell said. Quote, "In the near term, the election will have no impact on our policy decisions. We don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability." So what does that mean? The Federal Reserve Bank has what's called a dual mandate. That means the Federal Reserve Bank has to make all of their policy decisions based off of two things, two mandates. Number one is price stability. Number two is maximum employment. What that means in plain English is they're looking at inflation and unemployment levels. And what we're seeing today is that inflation has come off of its highs, but it's not at the 2% target that the Federal Reserve Bank wants. Do they really care about the 2% target? We'll talk about that in just a second. But then we have unemployment. Unemployment at the time of me recording this video is at 4.1%, which is higher than where we were last year. Last year we were in the mid 3%. But if we take a look at the last 50 years, 4.1% in unemployment is still historically extremely low. So unemployment is still very low, and inflation has not hit 2%. Now the Federal Reserve Bank generally, and when I say generally, I mean historically, the Federal Reserve Bank generally cuts interest rates as a way to stimulate the economy and boost inflation. The Federal Reserve Bank generally raises interest rates as a way to cool down the economy and cool down inflation. So if unemployment historically is still very low and inflation has not hit the 2% target yet, why is the Federal Reserve Bank cutting interest rates in the first place? And the reason why is because the Federal Reserve Bank says that they're confident that inflation is on pace, on target to go down to 2%. And that they're cutting interest rates as a way to protect unemployment, as a way to protect the job market, and potentially strengthen the job market. So the Federal Reserve Bank is hoping that they can cut these interest rates a little bit here and there as a way to continue boosting the economy without hurting inflation. Now you can start to see where this poses a little bit of a concern with what Trump is hoping for, because Trump is obviously hoping that Jerome Powell and the Fed will cut interest rates more aggressively. Because the purpose, according to Trump, of cutting interest rates is to make getting your mortgage more affordable, getting a car loan more affordable, making it cheaper and easier for businesses to borrow money, and making it cheaper and easier for banking institutions to borrow money. That way they can keep lending and investing this money into other institutions. And the concern, of course, is if you cut interest rates too much and too fast, that you can make the inflation problem worse. Like we've seen, mortgage or housing costs are still a big contributor to inflation. And by housing costs, we don't just mean the price to buy a home, but also the price to rent a home. And so that's a concern. Now, most people are already factoring in the Federal Reserve Bank cutting interest rates in December. We got a report after yesterday's inflation report saying that traders and Wall Street are now pricing in an 80% chance that the Federal Reserve Bank is going to cut interest rates in December. And the reason why that matters is because earlier this week, before the inflation report, Wall Street was pricing in a 60% chance that the Fed was going to cut interest rates again in December. So after we got this most recent inflation report, which said that inflation came in at expected, a little bit higher than the previous month, Wall Street is saying, all right, that confirms it. The Fed is going to cut interest rates in December again. Now, if the Fed cuts interest rates in December again, will that make them more likely or less likely to cut interest rates in 2025 after Trump is in office? Well, what Jerome Powell said in his most recent meeting is that we'll see, which was a very interesting cliffhanger because everybody was hoping that Jerome Powell and the Federal Reserve Bank would get some more insight as to what their plans are for 2025. And what Jerome Powell said is we're going to take things meeting by meeting and we're going to have a much better understanding of what's going to come in 2025 in December. So as of today, Jerome Powell has kind of left everybody on this cliffhanger that he's not going to change what he does based off of what Trump says. We don't know what's going to come next year. We'll have some better insight in December. And now we just got this new inflation report. So that's where we are today. And of course, if you are an investor, this is where it is important to pay attention to what's happening. That way you kind of have a backbone of understanding what's happening in our financial system. Market Briefs is my free newsletter where every day my team is working to keep you updated on what's happening in the markets. And then on November 19th at 10:30 a.m. Eastern Standard Time, I'm hosting a workshop for those of you that are a little bit more sophisticated investors that want to understand how the Trump policies can impact certain sectors, certain industries, and certain companies more than others based off of how government spending can impact the economy. And with that, I will see you on YouTube tomorrow.